You open the banking app late at night, and there it is, a balance that feels entirely too high, staring back at you. Credit cards operate as highly engineered, unforgiving systems. Without realizing it, everyday consumers regularly trigger 5 invisible behavioral traps that mathematically extract thousands of dollars directly from their bank accounts. This $5,000 balance represents the mundane reality of modern life: groceries, gas, and the unavoidable monthly expenses that quietly accumulate over a few weeks. What happens to this exact $5,000 balance over the next 30 days is a strict divergence point. Your next move will force you down one of 2 extremely different financial timelines. Credit card debt is dictated by the hidden mathematical consequences of how you choose to pay it back. Timeline A begins with a decision that seems harmless, paying only the minimum required amount on that $5,000 statement. This activates the hidden mechanic of daily compounding interest. Every single 24-hour cycle that you carry a balance, the bank calculates a percentage fee and adds it directly to your remaining principal. Look at this comparative graph. The top line stretches over a 15-year axis, the trajectory of paying the minimum. The bottom line drops to 0 in 1 month. Over 15 years, that minimum strategy generates over $6,000 in pure interest, doubling the original $5,000 balance. Timeline B avoids this cycle entirely. By treating the credit card like a debit card and paying the statement balance in full every 30 days, the interest calculation never triggers. Banks prioritize the minimum payment option because it acts as an engineered profit stabilizer, keeping users in permanent debt to maximize long-term bank returns. The second pitfall shifts from how you pay to how much credit you hold at any given time. Many cardholders make the error of viewing their entire credit limit as available cash meant to be spent. The credit bureaus evaluate your risk using the credit utilization ratio. This is the direct mathematical relationship between the amount of money you currently owe and your total combined credit limit. This animated gauge demonstrates how this ratio dictates your score. As your balance crosses the 30%, 50%, and 90% utilization thresholds, your credit score plummets. But by adopting a strict rule to keep utilization below 30%, the score rises back into the excellent zone. Credit limits are strict boundaries. Pushing up against them signals risk to future lenders. The third major failure point is organizational. Missing your payment due date by a mere 48 hours throws your account into immediate penalty status. This triggers a double penalty. First, the bank extracts an immediate late fee. Second, if that delay stretches to 30 days, a negative mark is stamped onto your credit report, suppressing your score for up to 7 years. Then there is the impulse trap at the checkout counter. You are offered a 15% discount on today's purchase if you agree to apply for a retail store credit card right at the register. Submitting that application generates a hard inquiry on your credit file. If the system detects multiple rapid applications, the algorithm interprets this behavior as financial distress and lowers your score. While a single inquiry seems minor, these small deductions can shift your score to a lower bracket, leading to higher interest rates on mortgages. Let's collapse these theoretical timelines and look directly at the statement sitting in front of you right now. Redirecting your financial trajectory starts with 4 specific actions. Begin by setting the account to auto-pay the full statement balance, which immediately removes the threat of interest and late fees. Second, mentally cap your spending at 30% of what the bank allows you to use. This protects your utilization ratio at all times. Third, avoid impulsive checkout applications to protect against hard inquiries. Finally, establish a 10-minute monthly routine to review your credit report for errors. Operating by these precise rules replaces the stress of a debt spiral with complete control. The piece of plastic in your wallet becomes an optimized tool for building long-term financial freedom.